I was able to sell my gold because,
gold just keeps going up and up and up and up and up and just doesn't stop. And that's not really gold going up and up and up. It's just the dollar dying.
which is to say that 1/2 of 1% of total savings and investment assets in the United States is denominated in gold. I realize completely that the liquidity that I hold in this floating abstraction called the dollar is costing me at least 300 basis points in real yield. The January market that we just had in silver. It's odd that every reason to own silver that propelled people to buy it for $100 in October existed 5 years ago when I bought it at 20. I learned that markets did work. And if they worked on the downside, they had to work on the upside. How much it costs to recycle silver, how much it costs to produce silver as a byproduct of copper production, how much primary silver production costs. And while I wouldn't get exactly right the inflection point between price and value, 100 million people a year were going to die of starvation, that oil was going to be $200 a barrel, all that kind of stuff, that markets didn't work. It was an important part of my narrative. It was where I was making my money. I identify as a blue-eyed sheik.
So if you saw, oh, sorry. If you
I
saw
believe
gold going parabolic, would you sell your gold, your savings gold, or would you hold on to that regardless?
it would depend on what the alternative uses of the cash were. I was able in 2009, I mean, not a lot of gold by Fort Knox standards, but a lot of gold by
Maybe
my
you did have
standards.
a lot of gold by Fort Knox standards. Nobody knows,
We
but
don't know, yeah.
okay.
I was able to audit my gold. That's true. And
Right.
I was fairly sure of its provenance.
Mhm.
Uh, but there were asset classes that I viewed as cheaper than gold. Gold is a unique form of wealth in that it's wonderfully liquid. And so, as an example, there was a pipeline company called Kinder Morgan. Um, Huge competitive advantages, and it was selling at a yield of 13. And I thought if the Fed um, added enough liquidity to the system to save the system, which was a concern in 2009, that 13 yield would probably fall to 5 through price appreciation of the equity. I thought that would be the clearing price uh, for that yield. And the yield was admirably sustained by a wonderful operation. A pipeline, you put goop in one end and you take goop out of the other end and you charge people for getting goop from point A to point B. It's a very simple business. So I was able to sell my gold because there was an asset class that I could buy that I believed in the intermediate term had a vastly superior return.
Gold going parabolic is not automatically a reason to sell. It may be the moment when cash alternatives become dangerously scarce. As Rick Rule points out here, his 2009 decision was based on a 13% yield from Kinder Morgan, not fear of gold's price. The deeper lesson is that sophisticated investors compare relative value rather than worship a single asset. For savers, that means selling protection only makes sense when another opportunity offers better protection and upside. Next, Rick Rule exposes why liquidity becomes most valuable precisely when everyone else suddenly needs it.
Liquidity is mostly useful to an investor for periods of time when liquidity is in short supply. I had a lot of liquidity in 2008. And the consequence of that in 2009 is I needed to decide whether I wanted to hold my gold to be able to sleep nights or I wanted to be able to deploy it to increase my wealth. And I chose door two. So it wouldn't necessarily be a hyperbolic trade that would cause me to sell my gold. Although if I had a trading position, I probably would liquidate it. It would be what alternative uses I had for my capital.
What I think you're saying is that, yeah, there is a theoretical situation where gold just keeps going up and up and up and up and up and just doesn't stop. And that's not really gold going up and up and up. It's just the dollar dying, right? And I think we both acknowledge this as a theoretical possibility. I think it's just more imminent than you do. And what you're saying is that it's not nearly imminent enough for me to actually take this seriously. And in the meantime, I'm just going to keep trading gold and silver as assets, liquidity assets, and the dollar is going to survive. And it's up to me to determine, where the next break is going to be, or around there, or whatever, right? So where I differ is, and I think where Phil differs too, is that we're in a situation where where debt keeps exponentially rising faster and faster and faster.
The dollar can look stable right until the debt burden makes that stability increasingly expensive to maintain. According to Rick Rule, liquidity matters most when markets become desperate for it, which explains why holding cash can look irrational during calm periods. But the opposing argument is that exponentially rising debt eventually forces investors to question what liquidity is actually worth. For savers, the danger is mistaking nominal stability for preserved purchasing power. Next, Rick Rule unravels the hidden conflict between dollar liquidity and gold's role as ultimate insurance.
Some breaks for a few months, but it just keeps going higher and higher, and there's no escaping that. And in my theory, there's only going to be one more major banking crisis, like something like 2008 or 2020. The next one, like in 2008, they printed, what was it, 16 trillion. In 2020, they printed, well, it was more than that. You can do the research or whatever number you want to say. It was more than 2008, whatever it was. The next one, whenever it hits, is going to be twice as much as what it was in 2020. And I don't see the dollar surviving past that. And I don't know how long it's going to take. I don't know. It could be a few months. It could be a few weeks. It could be I really don't know. But I'm just not comfortable selling my gold. Silver, okay, maybe, because it's more of a speculation than gold. Because once the Fed prints one more time, I don't see the dollar surviving, and then we get out of the dollar and return to money. I don't see any other currency taking its place. Um, I'm pretty sure you see this as a theoretical possibility, but why do you hold that it's so far off, or at least conceivably far off in the decades or however long you think it is?
Uh, the dollar's a confidence game, and people love to be swindled. Uh, Most people, and I mean really most people, I have this conversation all the time, Rafi, with people. Um, People do not want to confront the responsibility that they have for their future.
The next crisis may matter less for its trigger than for how much currency creation follows it. What Rick Rule is highlighting is that confidence, not arithmetic alone, determines how long the dollar system can stretch before behavior changes. That creates a dangerous timing problem. Investors may ignore debt accumulation until policy suddenly accelerates it. For anyone protecting savings, waiting for certainty can mean waiting until protection becomes expensive. Next, Rick Rule exposes why Americans keep choosing the dollar even when its arithmetic looks increasingly uncomfortable.
They want to offload the responsibility for that on society. And society makes it really, really, really easy to do that.
Yeah.
I give a talk to lots of groups, investment groups, but also youth groups, called The Arithmetic of America. And I talk about the United States economy from the perspective of a credit analyst, which is actually what I am. And if you do it in arithmetic terms, if you talk about the wealth creating capabilities of the US economy relative to our public and private debt, the circumstance is extraordinarily bleak, as it has been for a very long time. But it works until it doesn't. Again, if you compare the US dollar with other currencies, you suddenly become less nervous. Quoting Doug Casey again, very quotable. The dollar really is an IOU nothing. The chief competitor, the euro, is a quote, who owes you nothing. And the BRICS currencies, made up of a bunch of unconvertible and opaque economies, is obviously nobody owes you anything. So if you compare those three stores of value, an I owe you nothing is better than a who owes you nothing, which is better than a nobody owes you anything. The medium of exchange, well, let's look at it differently. Let's look at it arithmetically. In the United States, the largest savings and investment economy in the world, 23% of world savings and investment assets, the market share of precious metals and precious metals related assets in the US economy is 1/2 of 1%.
The uncomfortable signal is that a bleak debt picture can persist for decades without producing the collapse investors expect. Rick Rule's argument suggests the dollar survives partly because its alternatives can look even less trustworthy, creating a relative advantage rather than an absolute one. That distinction matters because institutions can remain invested in dollars without believing the fiscal trajectory is healthy. For ordinary savers, better than the alternatives is not identical to genuine wealth preservation. Next, Rick Rule reveals the tiny precious metals allocation that exposes how concentrated the American savings system remains.
Which is to say that 1/2 of 1% of total savings and investment assets in the United States is denominated in a dollar, or pardon me, in gold. Which means that currently gold is as relevant to Americans as a pimple is to an elephant's behind. Uh,
I agree. I agree with you. That's true.
and I think for that reason, the institutional bias and the popular psychological bias in favor of the US dollar suggests that the con goes on. I don't have enough faith in that I don't save in gold. I guess the third comment I have, and this is going to sound really arrogant, perhaps it is that I've been a pathological saver in my lifetime. Really, truly a pathological saver. Hitchhiking to university as opposed to spending a quarter on a bus. I've also worked very hard. I've been very lucky. And I don't spend much. So I have, relative to my needs, preposterous savings.
And I got a limousine sitting out there a mile long with 25 women just dying for me to go, woo!
The consequence of that, particularly given that I don't spend much money, is it's feasible for me to hold gold and US dollars. I hold, and I need to say, we talked earlier about the negative real yield on US dollars. I realize completely that the liquidity that I hold in this floating abstraction called the dollar is costing me at least 300 basis points in real yield, which is to say the yield that I get is dwarfed by the deterioration of the purchasing power of that specie. But I learned in 2008 that having liquidity when nobody else does is a powerful tool.
Gold does not need mainstream approval to matter. It only needs enough capital to eventually recognize what everyone else dismissed. This is where Rick Rule's thesis shifts. Gold's tiny allocation among American assets means the market remains structurally biased toward dollars, even while savers absorb negative real returns. That creates an asymmetric possibility if sentiment changes, because even a modest reallocation could have outsized effects. Next, Rick Rule exposes why deliberately losing purchasing power in dollars can still be rational insurance.
So I personally consider that 3% negative yield to be an option premium on having liquidity for a period in time in the market where other people don't and panic. Gold is probably a better form of liquidity, except in the immediate aftermath of a market decline. If you'll remember 2008, gold held its bid for 24 hours. And then the margin clerks, who don't care what you think about the asset, they merely want to clear the liability, will sell whatever has a bid, including gold. You will also learn that gold comes back much more quickly than other asset classes. But in the immediate aftermath of a liquidity crisis, what works, at least right now, is dollars. And so I have to hold dollars as an investor.
Right. Okay. So look, I think we see this almost exactly in the same terms. I described it a little differently, but I've said many, many times to my subscribers and to my Substack subscribers that we're in a tension between the two forms of liquidity, the natural form of liquidity, which is gold, which is ultimately what the dollar was based on at the beginning, and what I hold and what Phil holds, it is still based on now. because the only value of the dollar, the only purchasing power of the dollar ultimately comes from its gold value, which is maintained by that exchange rate. But what you said really strikes me because you are trying to balance your own emotions. You have a certain amount of savings, which just give you a certain amount of comfort, and other people have different amounts of savings, which gives them different amounts of comfort. And what the wisest thing to do as an investor is to balance your emotions so you're not freaking out in any given scenario or so incredibly satisfied with yourself that you think you're a genius and you're invincible.
The safest asset in a panic can temporarily become the most important asset you never wanted to own. As Rick Rule notes, gold itself can be sold by forced liquidations when margin calls overwhelm markets. While dollars gain immediate utility, that means the real issue is not choosing gold or cash, but surviving different phases of the same crisis. Investors who understand that sequence can avoid selling long-term protection at the worst possible moment. Next, Rick Rule reveals why emotional balance may matter more than predicting the crash.
Like that, those are both very dangerous emotional states to be in. So I think how I interpreted what you're saying is that given your financial situation and your saving situation, you're just trying to best balance your own emotions according to what you have, which makes complete sense.
Including the January market that we just had in silver. It's odd that every reason to own silver that propelled people to buy it for $100 in October existed 5 years ago when I bought it at 20. But most people who don't study, most people who prefer to feel as opposed to think, don't adopt a narrative until the narrative has been proven by price. But when the narrative has been proven by price, the narrative is less valuable, which is to say every advantage that silver had at 100, it had at 20. The difference is at 20, taking the risk made some sense. Speculating in the narrative made some sense. At 100, the narrative was more attractive because it had been proven, but all the juice was out of the squeeze. The nature of most human beings is that because price information is easy to gather and value information is hard to ascertain, people pay slavish attention to price without paying very much attention to to value. I believe that money is made on the delta between price and value. Not that you ever get it right. You just have to get it more right than the moron next to you. And that's been, responsible for whatever success I've enjoyed, that sort of discipline. And the understanding, even if I can't ascertain exactly what the value is, that value matters more than price.
So my final question here, and then I'll pass off to Rafi to close out if he wants to. How did your ability to buy what is hated?
Silver's biggest opportunity may arrive precisely when its story looks least convincing to the crowd. According to Rick Rule, the fundamentals that justified buying silver near $20 did not suddenly appear when prices reached $100. Only the narrative changed. That distinction exposes a recurring timing error. Investors demand confirmation before committing, then pay a premium for the confirmation. If you're protecting capital, the question is not whether the story sounds popular, but whether value still exceeds price. Next, Rick Rule unravels why price validation can actually destroy the advantage investors were chasing.
That is emotionally difficult. Like, I also bought silver when it was 20. I whaled into silver when it was about $20. I rode it up to 120 and I'm still riding it now at 60. That was, if it was to collapse to $14, let's say, just absolutely, crap the bed, I would have, my logic would say, I need to tell my wife we need to go and cash out our savings and go buy a whole bunch of silver, just back up the truck and get as much as we can. But she would be screaming at me. She said, "What are you talking about, Phil? You bought it at 20. You didn't sell it at 120. And now you want to buy more at 14." So that the normal that and that would be a very reasonable normal human reaction that I would have to try to override and say, no, babe, you don't understand, it's going way higher in the future. How did you teach yourself to react in this way, and how do you convince other people in case it goes to 14 and talk to my wife?
Um, Two good questions. I learned to do it in the beginning by not doing it. In the decade of the 70s, believed the Club of Rome narrative that the world was going to run out of commodities, that markets didn't work. The big thinkers in the decade of the 70s told you that by the year 2000, 100 million people a year were going to die of starvation, that oil was going to be $200 a barrel, all that kind of stuff, that markets didn't work. And as a young man, I believed that. It was an important part of my narrative. It was where I was making my money. I identify as a blue-eyed sheik.
The hardest trade is often buying the asset everyone around you believes you already proved wrong. What Rick Rule is highlighting is that emotional discomfort can become a useful contrarian signal when price collapses faster than underlying economics. His experience shows why conviction cannot depend on being socially validated, because the market rarely offers comfort at the moment of maximum opportunity. For investors, the discipline is separating embarrassment from genuine deterioration. Next, Rick Rule exposes the personal failure that taught him how to buy when consensus was screaming against him.
1982 changed a lot of things for me. I learned that markets did work. And if they worked on the downside, they had to work on the upside. That's when I decided that in my life, because what I did was natural resources, which are capital intensive and cyclical, that my I had three choices. No, two really. I could be a contrarian, which is what I became, or I could become a victim, which is what I was. And being a contrarian was a much more attractive alternative to me than being a victim. I had also, in the decade of the 70s, immersed myself fairly deeply in the oil and gas business. So I came to understand how value was created, which is to say, I developed a very deep working knowledge of the oil business. I've since developed a deep working knowledge of the mining business and a reasonable working knowledge of how value is created in timberland and agriculture, which means I have a head start over most competitors in understanding what value really is. I could walk your wife, if she had the willingness to listen, point by point by point, through how much it costs various aspects of the silver industry to create silver, how much it costs to recycle silver, how much it costs to produce silver as a byproduct of copper production, how much primary silver production costs. And while I wouldn't get exactly right the inflection point between price and value, I could make a case to her that the silver price had to go up. Whether she would be willing to listen after the trauma of watching your portfolio fall that much is a different question.
Markets can punish the right thesis long before they reward it, which is why expertise becomes most valuable when headlines turn hostile. Rick Rule's argument suggests contrarian investing is not simply buying unpopular assets, it requires understanding production economics well enough to distinguish temporary price damage from permanent value destruction. That creates a critical advantage over headline-driven investors who react after the move.